following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Thursday afternoon, or Friday if you happen to be listening on Friday, or Saturday if you're listening on Saturday evening. We're broadcast the same program 3 times, but on Thursday, it's live. You know, this marks 8 years since this bull market began. Would you believe that it was bottomed out 8 years ago today or yesterday? Very bottom of the market. And since then, it's risen 2.5 times. We're in a secular bull market. I've been talking about this. I was talking about this for the last 8 years, that we were entering into a time when we were going to have a secular bull market that was going to last for 1 or 2 decades. Well, we're almost past the 1 decade mark, getting close to it, and about to start the 2nd decade. Doesn't mean there won't be setbacks, doesn't mean there won't be downtimes, but I think it's very similar to what we saw in 1982 to 2000 when the market hit 1,000 in August of 82 and topped 10,000 before going into that funny time in the beginning of the 2000s. It's one of those times, and I believe that markets do not get old. Contrary to opinion, markets don't get old and die off because of old age. They continue to go, and it will take something at the end of this bull market to bring it to an end, and you know that I've talked about that. But that's another subject. You know, the idea is to put you, the listener, ahead of the curve instead of behind the curve. That's what we're doing with this program. I've got a great guest today who's got something that sounds like a great story. It is a great story. It's a great business. And you want to hear what he has to say? I also want you to know that one of the events that's coming up a week from Saturday, on March the 25th, is Play It 2 weeks, actually. Play It Forward. It's an event that raises money for high school music programs. It's a program it's an event. It's a Saturday night event. There's no auction. It's just a very fun evening. Contact us at Adams Financial Concepts if you'd like to participate, like to come. The tickets are reasonable compared to most gala tickets. It's $250 and $500. But it's a really, really great time. And I've been to a number of galas. This is really one of the best. And it raises money for a good cause. And I want to announce something that's coming with Adams Financial Concepts. It's something we began last fall. It's for accredited investors that have $1 million in net worth or an income of $300,000 for the last couple of years. We've got something special. I believe it's a real way to invest and get performance. But that's coming later in the program. I'll talk about that. But first I want to ask you a question. If you're out shopping and you're offered a possibility of a discount, a 10% discount now before you pay for the item, or a 10% discount after you pay for the item, what would you prefer? You know, there's going to be sales tax on that item. Would you prefer to have a discount before you buy the item or after you buy the item? That's a question. You know what? Mathematically, it doesn't matter a bit. Think about this. Suppose you buy an item worth $10, and to make things easy, say that the sales tax is 10%. So you're offered a discount before you buy the item, and now you get a 10% discount. You are only going to pay $9 for the item. The sales tax is 10%, so you pay a total of $9.90. Now assume on the other side that you take the discount after you paid for the item. So now you've got a $10 item, 10% sales tax. That's now $11. Less 10%, $1.10 means $9.90. Same thing, because math is commutative. And that's one of the things that works mathematically for financial investments as well. It's the same thing. And I've done a few times and talked about why 10% is the new 4%. Why 10%? Why do you need to save 10% instead of 4%? Why do you need actually to make a withdrawal of less than 4% of your finances when you retire? The market's not changed, but the math has changed. So if you go back and look at this, it all comes back to financial planning. Financial planning was really launched in the 1980s. There was a smattering before that, but where it got its big push was in 1987. The market crashed down. If you remember, October 19th, 1987, the market went from 1,700 to 1,200, was down 509 points in not 24 hours, in that daytime, that one day. The market plunged over 30% in one day. Think about it. 2008, the market was down 37%, but it took months to get there. October 19th, 1987, the market plunged that much in one single day. So there was a lot of fear. There was a whole lot of fear. People talked about things and things coming to an end. The market was going to come to an end. People were going to quit buying things. People were going to change. One thing that did happen is there was so much fear that actual commission revenue began to drop off a cliff. Getting people to buy stocks and sell stocks, that was the day in which most stockbrokers, financial advisors, we call them stockbrokers in those days, most stockbrokers got paid because they did commission work, transaction work. Very little was done on a fee basis. Almost all of it was transaction-based. And people crawled into a hole, if you want to think about it that way. They did not want to do transactions. And so commission revenue dropped off a cliff. And of what came about that, I was with Payne Weber at the time. They came out with an annuity or a CD that cost you nothing and paid very well. Merrill Lynch came out with the idea of financial planning. Financial planning. Think about it. And the concept's good. It's sold as preparation for retirement, preparation for paying for college educations, preparation for all that. How much do you need to save? And how can you do it in a safe way? Because financial planning was not just where you're going, but an asset allocation. The concept is if one thing goes up, other things might go down. But if some things go down, another asset will go up. That was the idea of asset allocation. Not originally. Originally it came from a different source. But by 87, that's the concept. We wanted to have a diversified asset allocation so that you had uncorrelated assets. That's financial speak for meaning that when one thing goes up, another thing goes down, or vice versa. That was the idea. And we had computers in those days. And computers were making it easy to do financial plans. Prior to computers, back in the 50s, back in the 40s, financial plans had to be done on paper. They weren't quite as elaborate or quite as accessible. But now, in 87, there were computers, and people were writing computer programs to do financial planning. It wasn't as sophisticated as it would become, as it is today, but the idea was there. To prepare people for retirement, to prepare that college education. That was the concept. That really was the concept. But from the financial advisor's view, from the stockbroker's view, from the brokerage firm's view, there was another issue. They wanted you to bring all your accounts into one place. That was the purpose of doing it. They wanted to gather up all that information you had, put it into one place so that they could get you to move your assets from all your other brokerage accounts and put them at Merrill, or put them at Payne Webber, or put them at Smith Barney. That was the concept behind the financial planning. They weren't so concerned about preparing you for retirement. They were concerned about getting those assets in, because eventually they knew that those assets would begin to create transactions, and that would increase revenues. That was the way the concept came about. It's grown over time, but the concept is essentially the same. Now it's become a thing unto itself. But I want to go back to my math problem. If you were offered a discount before tax or after tax, what's better? It's actually the same. It's a math problem. How does that apply to what we're talking about? Financial planning. Why is 10% the new 4%? That's the issue. It's a math problem. It comes about with financial planning. It's something we're going to talk about right after the commercial break, because we are coming to a commercial break. So don't go away. You want to hear, why is 10% the new 4%?
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
And Northwest Christian.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I started talking about financial plans and why 10% is the new 4%. Why is it necessary to save 10% instead of 4%? Because people used to save 4% in their pension plans and do well. So let me give you an example. Suppose somebody has an income of $100,000 and it's a flat income for a period of time, and they get a 9% return, and they're saving 4%. At the end of 30 years, they'll have $1.66 million. At a 4% withdrawal rate, that means they'll take out $65,000 a year. That's assuming, 9% return, which is essentially the stock market return, 4% withdrawal rate. If they have 40 years, which most people have when they're starting work at 20 and finishing at 65, 25, 65, 40 years means that will grow to $2.83 million. And at a 4% withdrawal rate, that means they're taking out $113,000, which is greater than the $100,000 in income. That's the way pension plans were set up. That was the way defined benefit programs were set up, so that you received a portion of your salary for the last few years because they were invested at a 4% rate. But as we've moved, one, to 401ks and also to saving and financial plans, that's changed. And why? Most of it comes down to the psychology of people. Most people have a greater fear of loss than they do of gain. There's a game that's been set up so that people had $20, they had 20 plays, they bet each dollar on a coin. Every time the coin came up plus, you got $2.50. Every time the coin came up heads, you got $2.50. Every time the coin came up tails, you lost your dollar. So it was the best interest to play every single round, 20 times if you played. And if you did, there was only a 13% chance that you would lose money. Only a 13%. 87% of the time, you made money. But you know what happened? Is a lot of people, as they went through this process, 58% of the time, people did not play every time. If they lost a couple times in a row, they would quit playing. Even though it made no sense. You flip the coin. If it comes down tails and you lose your money, you flip the coin, tails, you lose your money. There's still the same odds that it's going to come up heads on the next time. Only 13% of the time do you lose money. So how does that apply to this whole idea of financial planning? Well, the financial plans have come out with this idea of safe money, riskier money, and high-risk money, right? And at the bottom, it's safe money. That's what it's called, safe money. I call it illogical money, but that's my opinion. That's the money you put into CDs, you put it into bonds, you put it into a low returning. Some of it's going to be in cash. That stuff, when you're putting it into safe, is earning 2%, 3%, 1%. It's very low. Then you move up on the scale and you invest in a few other things. And as you move up the scale, you get a higher return, but a higher risk. And what you end up with is the math problem. You invest at 1%, 3%, 5%, 7%, and 9%, right? The top of the order is 9% in the stock market. 1% is CDs. The average is 4 or 5%. Guess what? We're back to our problem of shopping. If you're only getting a 4% return on your financial investments, that means to make up the difference between 4% and 9% or 4% and 10%, you have to put away 10%. What used to be putting away 4% was adequate for retirement means now you have to put away 10% if you're doing the regular asset allocation financial plan. And at the other side of the equation, now you can't take out 4% because it's not growing as rapidly. You're only earning 4%. So if you're drawing down 4%, what you're doing is you're drawing down essentially all your earnings. And if you have a bad day in the market, a bad year in the market, you draw down your account and that 4% becomes even larger. So that's what's going on. 10% is the new 4%. That's a logical thing to think about a financial plan. It's logical to think about spreading the assets over asset allocation. But what it really means is you're giving up some of your income by choosing something which I believe is not much safer. If you look at the actual numbers, if you look at 9% versus 4%, at the end of 10 years, if you're invested at 9% versus 4%, 4% growth over 10 years will take 100,000 to 142,000. 9% over 10 years will take it to 217,000. 217,000, if it drops 30%, means that you have 152. So if you have a time frame of 10 years of investing following a financial plan is going to put you at the same place as if you're 10 years at a 9% stock market return with a 30% drop. If you take it out 20 years, it's 4% gives you 210. 20 years at 9% with a 30% drop gives you 359. If you take it out 30 years, it's 311 versus 852. It makes, in my opinion, by putting money into safe money, it's not really safe money. It's safe only if you need the money in 1 or 2 years or a shorter time period. Other than that, it's going to be a negative draw. Means you have to put in more money and save. That's things where you can go to dinner, you can go to the Mariners, you can go to the Seahawks, you can enjoy yourself. You're sacrificing that for the longer term. It's a matter of math. It's a matter of math. You can figure it out. So that wraps that up. If you have a traditional financial plan, you're going to end up spending a lot more to save to get poorer returns. Anyway, there's more to come. I want to talk about other parts of the financial plan that I think are faulty, but that's coming after the interview. Right now, I want to introduce my guest. Ed Peterson is the CEO and founder of Wrench. So welcome to the program, Ed.
Thank you very much.
So why don't we start with your background?
Boy, yeah, I am a classic serial entrepreneur. I've started a handful of companies over the years, in the tech industry. And so Wrench, I started with 4 other people, is a little different. It certainly has a service provider component to it. And before I get into that, maybe I ought to pause and tell you guys a little bit about what Wrench does.
Well, let's go back and talk about your background before Wrench.
Let's do it. All right. So, as I said, I'm kind of a serial entrepreneur. I've started a company called TalentWise, a company called Intellius, started another company called Union Street, all very focused in the tech industry. TalentWise was what we refer to as a hiring process management company. So if you're bringing on a new employee, we would go through the process of doing background checks and onboarding that person to make them a successful employee on the first day. Intellius was an aggregation of public record and information, data information company that sold that information to consumers. Union Street was what we refer to as a personal information management platform, and we built that out where it allowed for wireless data and wireless information to be sent through your phone. Data to be sent through a wireless platform through your phone. So, again, I've had this career of identifying and seeing unique ideas or unique problems that are out there for consumers or enterprises and using technology to disrupt those spaces and provide better service to either the company or the individual.
And usually at a lower price.
And usually at a lower price. In fact, I'd say always at a lower price.
When you look at what's going on in the world today, we're finding disruptive technologies everywhere. Improving service, improving price. It's really something that has taken hold and is happening ever more quickly. But I'm getting away from that. Let's talk about Wrench.
Yeah, let's do it. But I think you're right on. I mean, at the end of the day, with a disruptive service, you want to provide more value at a better price point. And right. I think we've done that with Wrench. And so what we saw with Wrench was a problem that is continuing to get worse, which is no one enjoys dealing with their car. And that's with basic maintenance and service. You need new brakes. You need your tune-up. You need something as simple as an oil change. Whatever goes wrong with your car, it is really a big hassle to get that dealt with. And so what we did with Wrench, there's really 3 basic things we're bringing to consumers. 1, a certified and background check mechanic at your home or your office on your own schedule. 2, a guaranteed cheaper price than the dealer. And then 3, dealer quality service, though, a white glove service that we feel so strongly about. We actually guarantee it. We guarantee it with a 1-year, 12,000-mile parts and labor guaranteed.
3 things, and they all sound really good. We're going to come back and talk about those each individually. We're going to talk about what goes on in the car repair business. So don't go away. We're coming to a commercial break. We've got a lot to discuss. We've got a lot of other things to discuss beyond the interview as well. So don't go away. We'll be right back.
more About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Get away. Get a good job with or paying your okay.
Saturday, March 25th, Seattle's rock community gathers at the Triple Door for Play It Forward with the mission of empowering musicians and fans to make the world a better place. Guests include 2017 Rock and Roll Hall of Fame drum legend Alan YWS, performing with fellow Rock Hall members from Heart, Michael DeRosier, and Steve Fossett, plus many more special guests. For details on being part of this historic evening and helping to preserve music education for all public school students in Washington State, go to musicaidnorthwest.org, March 25th at the Triple Door.
OL. Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Ed Peterson of Wrench. We just started talking about Wrench and what it was. So why don't we repeat the three things that they do, and then we'll talk about each one individually.
Yeah, there's really three things that Wrench will bring to a consumer. And number one was a certified and background checked mechanic at your either your home or your office or another convenient location on your own schedule. Two, we're going to guarantee that we will be more affordable, a better price point than taking the car to the dealer. And in addition, we also are going to provide white glove, guaranteed quality service similar to a dealer, if you will. I mean, we're going to back that up. And we back that up with a 1 year, 12,000 mile guarantee on both parts and labor.
So there was a time, maybe 2 decades or 3 decades ago, when the service part of a dealership was a money-losing thing. It was where they had to do because it supported selling cars. Today, it's a profit center.
Yeah, that's accurate. It really is. In fact, one might argue that it's probably the profit center, right, within dealers. And dealers generally, when I've had my car and I've gone to the dealer, they treat you well. They do treat you well, and we want to replicate that. The problem that I think, at least that we've had, and I think our customers have had, is that, boy, it's just really hard to get to, and it's really expensive. And so, one of the simple stories I've always shared with people is when we were discussing the idea that has evolved into Wrench, I timed put a stopwatch on how long it took me to take the car to the dealership from my house and then hop on the shuttle and get downtown. And the dealer was, at that point, relatively close to my house, and it was over 2 hours. And that was just to drop the car off. I drove it there. And then I got the call later, you probably ought to do this, but we got to hold on to the car for another day or so. And, I, of course, paused and I was like, geez, the car seemed to be driving fine when I brought it in. And so, there's just things like that are really that convenience issue is something that is going to get even more difficult, for consumers or for people to manage.
And expensive.
Yeah, it really is. Dealers are, without a doubt, they're more expensive. I mean, there's a reason why I say, the number two of the three, right, was, we guarantee it will be cheaper than taking the car to a dealer.
So how does a dealer price? I mean, when you go into a car dealer, and recently I haven't gone to a car dealer because we have a Tesla that's fairly new. But when I had the Mercedes, I used to take it into the shop. They used to have 2 hours for this job, 37 minutes for this. What?
Yeah, so there's two things that create the pricing, which is labor and parts, and we're similar. You do mark up both of those because you're a business. You do have to be a healthy business. But every car, so if you pick the Mercedes, every manufacturer puts out a book every year and says, hey, all right, you have a 2014 Mercedes, and here's the model. If you need new brakes on it, here are the parts you need, and here's how long in labor you can charge. And at the end of the day, really what it comes down to is, how much are you charging for labor and how much are you marking those parts up? Mm-hmm. And that's really what it comes down to. And so one of the challenges that I think or one of the benefits that Wrench has is that we don't have the real estate footprint. We don't have the cost of having this enormous building. And so what we can do is we can pass those cost savings on to our customers. and we can get the same parts. We can get original manufactured parts. We can get wholesale parts, and we pass that savings on to the customers though. And I think that really is the key: is that we don't have that huge overhead.
And labor rates, I would imagine, are lower as well.
Well, it allows us to, because we don't have the shop overhead that is associated with all those things. We don't have the big bays. We also are not limited by the number of bays. And so, you call into a dealership, and oftentimes, they only have so many, spots they can run cars through, which is oftentimes, I think, one of the reasons why they may have to keep them overnight. They're just kind of juggling parts and juggling, when they can get to things and so forth. With us, we're not constricted by that. And so we're able to lower those price points down and pass that savings on to the customer. And I would tell you, over a dealer, on average, we're in the double-digit percentage-wise, and we were talking about math again earlier in the show. We are in the double-digit percentage-wise, generally cheaper than the dealers.
And cheaper both in labor rates and part rates?
Yeah, we really are. I would tell you that, look, at the end of the day, we're on par with an independent shop on the labor rates, and we are generally, and the reason why I'm pausing a little bit there is every dealer has a different labor rate. And so, a Mercedes labor rate is different than a Honda or a Toyota or a Ford or an Audi, or name your car.
So let's talk about the concept. If you buy a car, a Mercedes or a Honda or whatever, there's a push to have you bring the car back for service. At 30,000 miles, 12,000 miles, or maybe a light flashes up on the dashboard that says your service is necessary now. And they keep service records at the dealership and so on. So it seems as if the design of the whole program is for you to take the car back to the dealer.
Well, I think that obviously they would love to provide service to. They're in a business as well. I would just argue that we can provide the same quality and same service at a better price point and in a way more convenient way. Instead of driving to the dealer, hopping on the shuttle, sending that email that everyone's always sent. Everyone, I'm going to be a little bit late today. Dropping the car off, which inevitably is followed by the email of, got to leave a little early today, got to catch the shuttle. And so we can free that time up and do whatever you'd like to do with it. If it's on a Saturday, play with your kids, go to the soccer game. If it's on, during a work day, you can actually continue on through the day. So that convenience factor is really a big thing for us. The other thing that I would say is that, the great thing about cars is since 1996, they all have a standardized, what's called an onboard diagnostic system. And so we have the same scan tool that actually can read the engine error codes and all the other things that happen that you can get at a dealer. And so we can tell you exactly what's wrong and fix it in the exact same way.
And so your work hours are the normal that you find at dealers?
We're a little actually broader. It depends. And it actually, it also depends on the region. So right now, Wrench is live in Seattle from Everett down to the base. So Seattle, Tacoma, Bellevue, Everett, the region. But we're also in Phoenix, San Diego, and Portland. And so the reason why I pause there is, for instance, in Phoenix, we work later into the night, and it's what the market down there requires. But yeah, our hours are much are generally speaking, we, as I say in the first part, we try to come to you on your schedule, and so we're pretty flexible in the hours. Our core hours, though, are 7 to 6.
And do you work on Saturdays as well?
We work 7 days a week.
7 and Sundays.
Yes,
that's something you don't find at a dealer.
That is something you don't find at a dealer.
That's awesome. So how does somebody get a hold of you?
So right now, very simple. You can go to getwrench.com and put your license plate number in. We'll reverse that out, tell you what kind of car you have, and we will then, you tell us what's wrong with the car, and we will give you a price quote on it and allow you to schedule it all online.
All online. And what happens if you get out there and find there's something beyond what was?
Yeah, and so that's a good question. We do have a call center, a service center that and the phone number is on our site. You can call into, and you can troubleshoot with a service writer, and oftentimes what we're able to do is to come out with a couple of different options. So we say, all right, we've talked to you, and we say, all right, it's probably one of these three things. And so what we do in that scenario is come out to the customer with the parts required for all three options, and then we change the pricing and change the quote on the fly for the individual, and then we can just fix it right there. Now, there are situations we also do a full overview of the car while we're there. We do a quick check of the car, and so we can say, hey, you know what, your brakes, they're probably pretty good for a couple of months, but you might want to fix, get a new air filter. And so, or you probably might want to schedule your 50,000 miles service right now. And so we can actually give you a price quote with that and then schedule a follow-up appointment.
That's pretty awesome. I mean, what you're doing is truly disruptive, bringing an improvement, value, and at a lower cost. So again, what if somebody doesn't have or not, if they're not online, how would they get a hold of you?
So they can give us a call, and the phone number is on the site, which is getwrench.com, and that is probably the best way to go a hold of us. Sorry, I'm just pulling up what we try to do is localize a lot of the phone numbers, and so it's excuse me, but yeah, if you call into us at I guess I should pause and just give you the 800 number, or our toll-free number. That's probably easier, which is 844-997-3624.
It's pretty amazing. Now with cell phones, what we have, I don't know my wife's phone number either.
Isn't that funny?
Her name,
yeah.
I just plug in the name and it dials.
And it dials up. But we try to have some local numbers on each site, just because we try to make sure that we are routing people to the right. Obviously, we want to route people to the right providers as we go through, to our right mechanics in the right regions. So,
and the website is GetWrench.
GetWrench.com. You got it.
That's great. It's a great service, and certified mechanics guaranteed. It's disruptive, and it's well worth it. So thanks for being on.
Absolutely.
We've got more things coming later in the program. Don't go away. We've got stuff to cover.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So welcome back. We've got a couple more things to talk about. We had Wrench as our guest on the program. I want to tell you about my Tesla and repair. I have a Tesla. I like my Tesla. And so it was in an accident. My wife was driving into a parking place, hit the accelerator thinking it was the brake. The Tesla goes very fast, from 0 to 60 in 3 seconds. And she was already moving, and so you can tell that she was going very fast. She hit a curb. The car went airborne. The wheel hit the bottom of a post, and it was lucky that it hit a post. Hit the bottom of a post several feet in the air. So the front panel was damaged. The front fender, the axle was damaged. That was July 30th. So we called the Tesla dealer and said, where should we take this car? They said there's 3 Tesla places that are certified. So we took it to one of the places that was certified, Pacific Auto Body. Pacific Auto Body had the Tesla for over 6 months. Over 6 months. And from Thanksgiving, it's almost always been, the car's going to be ready in a week. The car's going to be ready in a week. They were dishonest in the first place because they told us that the insurance adjuster had not called them. I kept calling my insurance agent who said, you want to see the call logs? We're calling them every day. They were dishonest about that. Then they were dishonest about the parts that they needed. All this process, 6 months. Tesla has really stood behind the car. Tesla ended up giving us a loaner car. They took our car. They shipped it to California. They repaired it. They reimbursed us some of our expenses. Tesla's been wonderful through the whole process. Pacific Auto Body, on the other hand, I'm talking about this because I can't think of a worse place to take your car. So if you have a choice, do not take it to Pacific Auto Body. That's my negative advertisement for today. It's been an absolute disaster. Anyway, okay, enough of that. Let's move on to positive things. I found an old article. I just happened to be thumbing through things, and I found an old article from the Wall Street Journal, September 8th, 2009, where it talked about a typical investment portfolio of 60% stocks, 40% bonds, lost about 20% of its value in 2008, 2009. Standard portfolio construction tools tell you that that's only going to happen. A drop of 20%, like that, it's only going to happen once every 111 years. So how is that determined? Why is it important? Because your financial planners, and I talked about financial planning earlier in the program, your financial planners are using that information to plan your future. They're using the same mathematical construction that you find that. If you're using that, those mathematical assumptions are wrong. You know, they're based on what's called the normal curve, Cauchy distribution. I'm a mathematician. It's that bell-shaped curve. And the bell-shaped curve is really nice to work with because the average is at the right in the center of that curve. If you look at some of the other curves that people talk about, the chi-square curve and so on, the average is not there. If you look at incomes, the average income is not at the peak of the curve. It's a curve that goes up and down and then slides way off to the right. It's a funny shaped curve. The bell-shaped curve is a really nice curve, and the average is right in the middle. And not only that, you can calculate standard deviations, what are called standard deviations. 66% of the time, it's going to fall within one standard deviation of the average. 95% within 2 standard deviations. 99% of the time within 3 standard deviations. So that's a really nice mathematical curve to work with. You know, and there's a number of items, a number of things in the world that are part of and do look like a bell-shaped curve. You know, you have professors that grade on a curve. That's what they mean, the bell-shaped curve. The average person's going to be right in the middle, and everybody's going to be spread to either side. It's wonderful. It's nice to work with, but it's not accurate. You know, my first job was for Pacific Gas and Electric. I worked as a person in the operations research department. Hired in, I was in grad school at the time. I was going to grad school at the time. Hired into the operations research group. And for Pacific Gas and Electric, a big thing is to, like other utilities, is to predict power consumption. do we need in 10 years, in 15 years? Because if you're putting in a dam or building a big power plant, if you do it too soon, you end up paying money that you don't recover. And if you do it too late, you end up with brownouts. So forecasting power demand is a very critical factor in an electric utility. And that's the department I was in. The normal way to do that was to take out last year's book, count the number of dividers, put that number of dividers in a new book, move things out, try to forecast. But when I was starting in the operations research department, we had computers and we had new methods to really calculate. We could do linear regression. We could do multiple regression. We could do canonical correlation. We could do a number of mathematical things to get a better fix. And we could look at different variables. If you have a growing population, you're going to need more electricity. If you have a declining population, you're going to need less. But we looked at every variable we could think of, and we threw it into the mix and said, okay, what's the best predictor of electrical consumption over the long term? Do you know what we found? Know what we found? Found the best predictor was the number of people on Alcatraz. Number of prisoners on Alcatraz. What? I mean, it makes no sense. And that made no sense. But it taught me about one thing. You have to have a causal factor when you're predicting things. You have to have a cause. And if that was really a predictor of electrical power consumption today would be zero because there's no prisoners. When you're dealing with statistical terms, you're looking for something that's accurate, that's repeatable, and that's causal. Using a normal curve in financial planning is inaccurate. It's going to lead to bad results. And we saw that in 2008, 2009. Those predictions, those Monte Carlo simulations that said you're not going to run out of money except a small percent of the time, didn't work. That's financial planning. I have a different approach to financial planning. I believe that it's superior. It returns better results, and it allows you to use your money in the way that you want to use your money rather than trying to put it away for the long term. And you still meet your long-term goals. That's part of what we do. Adams Financial Concepts. Check our website. Join us there. Anyway, that wraps up the program for today. Have a great weekend, and I'll be back next Thursday, Friday, and Saturday. And if you miss part of the program, you can hear it Friday or Saturday, too. Have a great weekend.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts.
Saturday, March 25th, Seattle's rock community gathers at the Triple Door for Play It Forward with the mission of empowering musicians and fans to make the world a better place. Guests include 2017 Rock and Roll Hall of Fame drum legend Alan White of Yes, performing with fellow Rock Hall members from Heart, Michael DeRosier, and Steve Fossen, plus many more special guests. For details on being part of this historic evening and helping to preserve music education for all public school students in Washington State, go to musicaidnorthwest.org, March 25th at the Triple Door.
The following program sponsored by Adams Financial